So we got the whole range from faculty. Thank you, Powell and Padma, for coming, and also undergrads. Last time we had Professor Hadzakis as well from Stevens Tech, and we've got a couple of guys from Stevens here helping us. Venkat and Atharva, thank you. Ching, I guess, is going to be recording, but she's in the back from Rutgers. So we try to get a lot of the students involved from different programs, and I'm sorry that, with the weather and summertime, it looks like it is what it is. So
it's perfect. I prefer this size.
But I appreciate Dr. Muralidhar coming all the way in from DC. It's very kind of him to take the time and make the effort to educate us on some very important issues here at hand. So we're going to hopefully debunk some, some of the stuff that you're taught in the classroom. We're really thrilled to have such an accomplished speaker, and as I like to remind people, and it's good to always have such accomplished speakers, that most of our speakers have such long bios. I don't do the whole we don't recite bios because they're all very accomplished people just like yourself, and so MIT, PhD, World Bank, JP Morgan, FX Concepts. I think that's when we connected first, FX Concepts, going back over 20 years, and you've been running lots of other things lately, as well as teaching at Georgetown. So without further ado, Professor Arun Muralidhar, I'll let you...
Thank you, Milind, and thank you all for coming out. First things first, very informal. If I say something that you either don't agree with or don't like, put your hand up, let's have a discussion. So I've got a few slides that I put together. But interestingly enough, actually, this project started probably about 25 years ago, actually. And in fact, Powell just asked me a question, what is M-cube? And I was writing a paper, Bill Sharp had written the Sharp ratio paper. Franco Modigliani, who was my advisor, wrote a paper called the M-squared, and we'll come to that in a second. And he sent it to me, and I said, Franco, it's wrong. And so then we had a big debate, and then I came up with this measure called M-cube. And it opened the door for me realizing that pretty much everything I'd been taught in finance was wrong. Okay, so I've been spending the last 20 years trying to prove that finance theory is pretty much completely wrong the way it's taught. And that becomes the basis of my presentation. I'm more of a practitioner than I am an academic. I do publish. Just a little bit on my background. I issued bonds for the World Bank after I got my MIT from Sloan. JP Morgan, then I set up my own business 23 years ago. I still run it. It's both a fintech as well as an asset management company. I write books that nobody reads. Not a good way to plan your retirement. You don't make a lot of money writing books. But now I spend a lot of time more on the practical aspects of finance because I wish somebody had taught me this when I was a student, right? So I teach at Georgetown. I prefer to teach undergrads only because by the time you get to the master's program, you've already been brainwashed, right? So, so what I'd love to do is, my agenda for today is hopefully three things, right? One, I'm going to try to prove that finance theory and practice is pretty incorrect. Okay, so a lot of what you've been taught is probably wrong. A lot of what pension funds around the world use as techniques is probably wrong as well. And so once I break that down, then I've written this asset pricing model, which I call GRAPM. It's called the Goals and Risk-Based Asset Pricing Model because the original name was going to be CRAPM, which is the Capital Relative Asset Pricing Model, and nobody was going to publish a paper with that title. So that's basically job number one. If I can prove that to you, it's a good day. The main point, and we were talking about this briefly, you just brought this up, is your previous speaker talked about differences in preferences, right, on gains and losses. One of the things that finance theory completely misses is that all decisions are relative decisions in our business. Okay, and I'll talk to you about the degrees of relative decision making. But there are beautiful papers by Bill Sharp and Bob Merton that touch on this and then don't go into it any further. And until you're a practitioner, you don't realize how important those aspects are. Okay. And then for people who are interested, I've got lots of problems for you to work on. So I'm going to throw out stuff for you. I'm happy to engage with you. And if you want to do some research on it, I'm happy to help you. Maybe there's a paper that comes out of it as well, okay? So I don't have all the answers, so that's what I'm giving you as an option. Okay, so in case you fall asleep right after this slide, I'll give you the whole thing in one slide and then we'll come back. The reason I was writing all these articles about how do we bring practice into theory is what I call the 4-3-2-1 principle, okay? So the first thing is there are 4 realities of investing that are not in current theory, right? So what's the first assumption in finance that you're taught? what is the first assumption you're taught? Investors maximize the expected utility of wealth, right? Okay. What's interesting is actually the CAPM, which is what you're all taught, treats wealth as an absolute goal. But wealth for wealth's sake has no meaning. Okay? The wealth that you have for your retirement planning, I'm going to show you in a second, is so different from the wealth you need to finance your kids' education or to buy a home. Okay? And that's what Kahneman and Tversky actually first find out is it's the relative wealth that matters. Expected utility theory ignores it, CAPM ignores it completely. But also, in typical finance theory, they assume you have only one goal, which is wealth. In real life, you have multiple goals. Okay? So I'll start with that. Then what happens is I'm an asset manager, Milind is too. We're agents of the people who own the money. So that's the second level of relative decision making, and there is a bit of work in the agency theory literature in finance, but the problem is they don't adjust for whether the agent is skillful or not. So a lot of people in our business make a lot of money being completely lucky because you're using the wrong techniques to understand whether people are skillful or lucky. Okay? So that's the second part that's wrong. 3 is when you actually look at the investment policy statements of either a pension fund or an insurance company, they actually tell you very clearly what their objectives are and what their risk tolerances are. So in finance theory, you have this arbitrary risk aversion parameter. In 30 years of working in the industry, I've never seen a utility function. I've never seen a risk aversion parameter, right? So straight away, finance theory kind of blows up when you look at reality and you say, wow, somebody forgot to sort of look at all of these things, right? The 3 is, again, and you find a lot of academic papers that don't take a look at the 3 most important aspects of investing. Okay? So the first one is, what is my asset allocation? How do I distribute my assets? So that's the Markowitz paper sets you up with that. Then the second question is, how do I price the assets? So CAPM was the asset pricing model that was consistent with Markowitz and Tobin. And then the third one, which the academic literature misses completely, is what is the risk-adjusted performance? Because once I hire Milind, I want to make sure that he's actually giving me performance, which on a risk-adjusted basis, when I compare to him, is advantageous. Okay? So I'll talk to you a little bit about that. Very few academic papers combine all 3. CAPM is the only one that actually gets it correct. The arbitrage pricing theory doesn't do anything. The behavioral guys have no clue about half of these topics. So a lot of finance theory misses this practical aspect of investing is you have to know what the asset pricing model is. You have to know what asset allocation is. And then after you do the investing, is the risk-adjusted performance appropriate, right? So now what I'm going to prove, and I've actually managed to do this, is once we get into relative investing, you have to create what we call relative risk-free assets. And I managed to do this in Brazil. We've created 2 new financial instruments. And if I have those 2 and 1 absolute risk-free asset, what was called F in your capital asset pricing model, the treasury bill is typically the proxy for this, then you can price all assets. There's no such thing as a market portfolio. It doesn't exist. And that's why I find factor investing kind of falls apart, right? Because factor investing is based on CAPM being the model. CAPM is a very, very special case of a much more general theory. Okay? And Sharpe has actually admitted that as well. Okay? That's kind of the high level, 20,000-foot view. Okay? I'll skip all this and we'll come to it later. So there's a beautiful paper by a professor out of Stanford called Paul Fleiderer. It's called The Chameleons. And what he says is, once finance theory or economic theory publishes a paper, it has a bunch of assumptions which are not connected to reality. And then the next person who quotes that paper just uses that assumption. And then by the time you're 10 papers in, it's become a chameleon and it's changed colors completely. And people forgot that the first assumption was completely wrong, right? So in finance, if you take a look at what finance theory's papers, even today in Journal of Finance, RFS, whatever the journals are, the top journals, you'll still have people talking about maximizing utility. Like I said, when you look at the investment statements, and I'll show you that of some major investors, people don't care about utility. We don't know what it is. We really care about relative risk-adjusted returns. They talk about wealth. I care about relative wealth, right? And I'll talk to you in a second about what relative wealth is. You know, et cetera, et cetera, et cetera, right? So as you walk through all the assumptions that form the basis of everything that you're taught in your finance programs, most of them are what I would call chameleons. They don't exist in reality. Okay? So people forgot that these were cute models that you started with, and now they're applied blindly by every academic who wants to get published. And this is my running fight with the editors of these journals, because if they accept my paper, then they're basically saying 50, 60 years of finance theory is wrong. Okay?
Do you have any feelings which journals start to accept this
None at all.
reality?
None of them. So I'm having a big fight with Journal of Finance. I'm having a fight with AER, RFS, because they can't accept it, because all the journal editors have only published papers on this assumption.
Yes.
Right? So my first line of my article that says, by the way, this is so removed from reality,
Yes.
I literally had the journal editor saying, your paper's too practical.
Yes.
Like being practical in finance is a problem, right? Literally, she wrote that to me. And I said, you got to be kidding.
Yeah. This is a trading strategy. This is not.
Not even trading strategy. She just said, you cannot look at reality, right? We want our academic world on which we've published all our papers. If we accept this, then we have to write off everything from Sharp onwards, right? So they have no interest.
So no idea where to send this stuff.
I just publish. I don't care to publish, right? So I just put it up on the internet. I'll show you how I've tried to change the practice, at which point they'll have to accept it, okay?
Yes.
And these are these innovations I created in Brazil, which we'll do in the rest of the world. So what I had to do was, once you get into this relative world, and just to go to the title of the presentation, I created a bond called SELFIES, okay? And it stands for Standard of Living Indexed Forward Starting Income Only Securities, and I'll explain that in a second. And I wrote it with a couple of my PhD classmates from MIT, and then Bob Merton and I have been writing this quite a bit. And Brazil actually issued this bond in 2003, okay? And I'll explain it to you in a second. And at the same time, I also created a similar version called Bonds for Education and Student Tuition, which Brazil also launched in 2003. And now I'm talking to countries around the world because they've done very well, that this is going to be the new innovation. Okay, and I'll explain what this is in a second. Okay, so now let's start with what I think finance theory misses, which Bill Sharp actually corrects in 1990. It's interesting he actually corrects it, which is if you're a 25-year-old, all of you, planning for retirement, how many of you have read Modigliani's life cycle hypothesis paper, right? The classic paper, right? He gets his Nobel Prize for it. And what Modigliani argues is that the reason for us saving is, if you're a 25-year-old, is you want no income for 40 years because you're working, that's when you're saving and you're investing. But then when you get to retirement, you want a steady stream of cash flows for, let's say, 20 years, and then we know that you die, okay? So this is the goal of investing for retirement, okay? In America, we have these programs called 529 plans, which is if you're saving for your child, you put your money in there and you want nothing for 18 years, and then when the child goes to Pace or Stony Brook or Carnegie Mellon, you want a certain amount of real income for 4 years so that they finish their degree, okay? So the goal for investing is not wealth, it's this set of cash flows, right? And that's what finance theory misses right up front, right? I care about how does my wealth help me achieve this, right? And this, as all of you know, if it's nothing more like a bond cash flow, the value of this bond is changing every day as interest rates and inflation are changing. So you've got a moving target, which is your goal, and your wealth is trying to keep pace with it. So if you just say, put my investment strategy in a Markowitz optimizer and I get a 60-40 portfolio, relative to these cash flows, that's highly risky. In fact, I would argue it's completely wrong. Your goal is to make sure that you have a portfolio that gives you high likelihood of getting this for your risk tolerance, okay? Now you can do this for everything, buying a house, financing a wedding, right? In Turkey, people want to create a bond for having your wedding. In Africa, when you die, funeral expenses are really high. So you could have literally a financial instrument for every one of these goals. These are the two that I focused on because they're the biggest goals, okay? So is that everyone clear with that? So it's called goals-based investing. I don't know if any of your classes, they talked about goals-based investing, but in practice now, that's become the sexy word. GBI, goals-based investing, is now, if you take a CFA program, goals-based investing is a module. But the question is, how can you have goals-based investing if you don't know what the goal is? I just said, let's match out the cash flows. Once I know what the cash flows of the goal are and I can price it every day, then I can set my assets to match the goals, okay? So rather than focusing on wealth, right? In the relative world, you focus on wealth over your liabilities, where both are stochastic. Okay?
This is like actuarial.
Exactly. We call it funded status, right? And the simple idea is that if your funded status is above 100, which means you got more wealth than you need for your goal, immunize it. Everyone knows what the word immunize means? That is, just find a portfolio of assets that exactly matches this cash flow, get out of business, go to sleep on the beach, you don't need to do any more work, right? The reason all of us are all investing is our funded status is typically less than 100%, right? That is, the amount of money that we have to invest is less than what it takes to match this, and that's why we have to invest in risky assets. Okay? So the basis of wanting to invest in risky assets is that we haven't saved enough to be able to match our cash flows. Ideally, once you get enough wealth, you should just lock it up, and then you can, gamble with the remaining money if you have any extra. Okay? Does that make sense, right?
Where do you gamble?
I do triple levered short nat gas futures. Literally, I'm not kidding.
There's a lot of investors
Because I've got
who
enough.
secured those cash flows.
So I've secured my cash flows, right? That was my goal in life, was get enough cash flows. And then I've got play money, and he knows how much I lose because I'm a terrible trader. But yeah, so literally this is how you should split up your portfolio, is figure out what you're doing for your goals, and I'll show you how the asset allocation recommendations change completely if you care about how skillful you want to be, okay?
What about endowments?
Same thing. So in fact, Bob Merton writes a paper in 1993 saying an endowment is nothing more than a set of cash flows that they should be financing, whether it's for tuition or capital investment, etc. All these endowments went to the stupid Yale model, complete stupidity, right? And they blew up in 2008, right? Because there's no matching to the cash flows. What's happening to them right now? They're all out there borrowing because they didn't match their investment strategy to the cash flows of the university, right? So the moment Trump pulls their funding, foreign students are not going to show up. They've got all these illiquid assets for a very liquid cash flow. So guess what they're doing? They're closing departments, they're laying off staff because of bad endowment investing. Okay, so Bob Merton writes this brilliant paper in 1993 saying your asset allocation for an endowment should be matched to what your cash flows of the endowment are all about. But everybody said, oh, Swenson is a genius because he put all his money in illiquid assets. They blew up in 2008. And I'd met the guys before that saying you're going to blow up. But our industry doesn't care about facts. The hype, and you pay enough people 2 and 20, they'll say that you're a genius investor, right? So that's what endowment investment is completely screwed up. And now pension funds have copied that model too. Right? So we have a potential blow up in the market because the markets become so illiquid with these pension funds and endowments. So they haven't matched their cash flows to what is needed for the institution, right?
But your critique would hold even if they didn't have so many liquids, right?
I don't care.
It's scandalous that they have so much of private equity up to their eyeballs, and now they're trying to exit.
That's exactly it, right?
But even if they just had alts, which was the David Swenson original model, which, let's say you take out the liquid and you just had hedge funds and liquid exposure,
yeah.
It would still not be the case that you're necessarily.
So even if they went that much into illiquids, what I was arguing with them, and I made a lot of money in 2008 shorting against these guys, right, was inherent in every private asset is a lot of beta. It's levered beta. So you want to be managing beta dynamically, which is my day job, right? So my day job is managing beta dynamically. These guys just thought if I give out my money to a private equity investor, I don't need to do anything. Bad assumption. Because when you need to get liquidity, you should be shorting the beta. They have no concept of doing that, right? So they just ignored this side of the equation completely. Nobody read Bob Merton's paper in literally 1993. And I'm happy to send you guys references. Such a simple paper. Bill Sharp writes a paper saying pension funds in 1990 should set their asset allocation relative to what their cash flows are, right? It's amazing how this is completely ignored by the literature, right? Everybody agreed?
Interestingly, I spoke to the UC regents last year, and
Oh yeah, I know Jagdeep very well.
I mean, so some of those guys are actually not even hedging now. They have no hedged assets. They're basically just saying, well, we're long and strong and long-term investors. Why should we hedge?
Which is nonsense. I know Jagdeep and his team very well. This is the problem: is you have guys who just join the gang because if Yale is blowing up and Harvard is blowing up, I can blow up, right? So then there's comfort in being part of the gang, right? So what's interesting is I managed to get Brazil to launch both this retirement bond and the education bond. It's worked very well. And actually, I'm talking to the UK government. I'm trying to get Treasury to do this in the US. We're talking to India, Turkey, et cetera, right? Because every country can issue this bond, and we can talk about that in a bit, okay? Everybody agreed on this, that the first thing you have to ask is, what am I managing this money for, right? And if somebody says, I want it for my kids' education, and somebody says, I want it for my retirement, you cannot use the same asset allocation model because you're going to have very risky portfolios. And this naive 60-40 that everybody uses, completely wrong, right? Because most investments will have a heavy proportion of fixed income component to it, as long as there are predictable cash flows that you need, okay? Does that make sense? Okay.
I mean, conceptually, the bond should be very simple if you knew exactly how much tuition would be 20 years from now. But like, do you have to do inflation?
Yeah. So the way the bond is structured, and we can take either one, is I designed it so that it pays $10 real per year, okay, for when you turn 65. And so they issue a series of these, right? And then the reason I picked 10 was your average person, we were talking about, Irina was talking about this, your average person has no financial literacy. But they know that relative to today's income, let's say I make 70,000 and I'm able to survive on 70,000, then if their goal is, let me get 50,000 from my private savings because Social Security gives me 20, each bond pays 10, the only goal is buy 10,000 of these bonds. What we did is we embedded compounding, decumulation, accumulation, and inflation into the bond, so that the average person on the street has to do no math, right? They literally have to say, if my goal is 50,000, each bond pays 10, I just have to buy 5,000 of these bonds. There's an app in Brazil. You answer 2 questions, press a button, and the transaction takes place. Same thing for this one, right? So here what you need is you have to have this index to tuition inflation. So I sent this idea out to like 100 CIOs of endowments saying, send this to your guys who are doing fundraising for the campus. This is a much better way to raise liquidity than issuing a traditional bond. Right?
But the existing 529 plans don't.
Disaster.
I don't remember, but I mean,
Stupid.
we actually launched the first one at Merrill in the 90s, and my recollection is they were just investing in our funds, like mutual funds.
So what they do is they have this thing called a target date fund, right? So this is time, right? And then this is the allocation to equities, right? And these stupid things are called TDFs, target date funds. And the allocation to equity starts at, let's say, 70%.
Right, and it goes down.
And then it just goes down.
Yeah.
Okay? Okay, so here's a quiz, right? So this is your retirement date. What is wrong with this product? Okay? In principle, you're taught in finance, you rotate from the risky asset, which is equities, into bonds. As you get closer to your target date of retirement, the government says that if you do this, you cannot sue JP Morgan or Merrill Lynch because they put your money in a safe asset. What is wrong with this strategy? What does your outcome at retirement become a function of?
Oh, your entry point.
Okay, so let's start there. This is where it gets really funny. So what is the entry point a function of? So entry point is you're 25, right? What is your entry point a function of?
Well, I mean, more market.
Sorry? No, your entry point is a function of the date you're born.
Yeah.
What is that a function of? The day your parents had fun 9 months before that. So your whole outcome in any of these strategies literally becomes a function of when your parents decided to get happy. Okay? That's the basis on which $3 trillion is being invested today in either retirement accounts or 529 plans. Complete nonsense. And the regulator gives people a free pass for doing this. It's amazing, right? This target date fund is complete nonsense. It's a complete random outcome. And all these vendors have managed to convince the Department of Labor that these are good products. And that's your problem.
I totally agree with you, but I guess in the US, because of circumstantial evidence, it's hard to argue against decades of 60-40, but in most other countries where that's not been the case, you'll find a much more receptive audience, right? Like if somebody is unlucky enough to be born in Afghanistan or Pakistan where the equities haven't gone up in the long run,
so this is the problem.
You can't sell 60-40.
The sad part is the Fed, by bailing out the markets and building out its balance sheet to 13 trillion and now it's 7 trillion, has destroyed any market discipline, right? Because everybody knows, lever up, too big to fail, you're going to get bailed out, right?
Exactly.
That's your problem.
Look at what happened with the
That's it.
obliteration day on April 9th. I mean, the retail investor actually bought this dip.
Yeah, exactly, because they've been trained.
Institutions bailed because the data was suggesting Armageddon, and it was logical to actually cut your beta, but the retail guys jumped in.
Because they've seen this behavior enough times. You've trained them to saying.
Pavlovian response now.
Exactly. When Silicon Valley Bank went belly up, I had a couple of friends who were, running small companies, and they had their accounts there on Friday, and they were calling up, freaking out, saying, "Oh, I can't pay any checks." So don't worry, Monday you'll be bailed out. They cannot let it go under. The Fed has created a condition which is just take as much risk, and this is what the endowments and the pension funds are doing. They figured out that if we take a big enough risk, systemically, the Fed will always bail us out. So I have some sympathy for Trump going after Powell for the wrong reasons, but he has created this environment of, hey, don't worry, we'll always be there. If the market flips a little bit, I'm going to bail it out. Right? So they've killed the discipline of thinking about how to make effective investment. So these bonds now exist, right? So now it's no longer theoretical. And if I get it to do in a few more countries, then it'll be hard for the journals to say no to this anymore, right? And what it does is, and I'll come back to this in a second, right? So this is the Brazilian bond, right? Pays you nothing until your date of retirement, and then for 20 years it pays you a steady stream. The education bond pays you nothing till your child is 18, and then it pays for 5 years because undergrad is 5 years in Brazil. You can literally buy this in slices of as little as $1 at a time, okay?
So, I mean, this all assumes that, we can predict the government behavior for the next 30 years. Like no quantitative easing, no printing. How do you know?
So the benefit is the inflation is covered.
The inflation, which you still have to forecast.
No, you don't have to forecast it. The beauty of this bond is the inflation is built into the payment. So you don't have to do any more inflation forecasting. So you're buying the inflation protection for every cash flow date.
And who is
the government.
taking the risk?
The government.
Inflation?
So this is the reason we call the bond selfies. Was Bob Merton had a really good idea.
But when the government takes the risk of inflation, and they also control the printing of the money, so they can keep printing to cover the risk.
Absolutely. So the danger is the more they print, the future obligation of inflation goes up.
The more
right?
they print.
Yeah, so that's why I want to get the IMF now to be one that controls them a little bit. But Bob Merton had an even better idea. Okay, so the reason we call the bond selfies was he said index the bond to a value-added tax index. Why? Because I just don't care about inflation, right? I want to also consider standard of living, right? Which is ignored today. When you buy inflation-linked securities, if the standard of living in the economy changes, then when you get to retirement, you're going to have worse standard of living than the average. So what we said is if you create a bond that indexes to a VAT index, then the government is hedged.
Right.
Because their revenue comes in VAT, they're paying out VAT linked. This is much better than issuing inflation linked or nominal bonds.
Why not just gold denominated?
Because it doesn't cover this. Standard of living is not covered.
I don't know.
You can have
Standard of living.
So if you look at per capita consumption in an economy, there's a real component and there's the inflation component. The real component is the fact that the basket is changing. The Tesla, or they're buying more stuff. So you want to keep standard of living at pace when you get into retirement. Gold doesn't track that. Whereas a VAT index is telling you what people are buying in the country, therefore it's a better hedge. So we may get the UK to actually create a value-added tax indexed bond for retirement. And similarly for education in America, you want it indexed to tuition inflation because that's gone like this. CPI has only done this, right? Okay?
Well, that was my initial point about the hedging the education
Component.
as you point out, like the rate of.
That's it. So, but look at it from the perspective. If you're Stony Brook or your Pace, you want to issue this bond because when the kid turns 18, you're going to get their tuition, which is what you're going to pay out to the person who owns the bond. So they're completely hedged to issue this instrument, right? They have a natural hedge as long as they can keep the recruitment up, right? That's basically.
But for the retirement side of the equation, let's suppose for a moment that inflation is a good enough proxy, and I agree with you on the standard of living, it makes sense.
Yeah.
But there do exist instruments like the TIF.
Horrible instrument.
In theory, if that was a good enough instrument, then everybody should just buy tips and therefore 1K and not do any 60/40, right? But it just comes back to this whole notion of, do you want to ride beta for the long term or not? And that's Jeremy Siegel on his...
But this is the problem. Because of finance theory, the way the cash flows of a TIPS bond goes, right, is you get real coupons for, let's say, 30 years, right? Yeah. And then you get this big stub principal at age 55 with the inflation adjustment on top. Whereas what I'm saying to you is I need the cash flow starting here, which has nothing to do with what these cash flows are. So I've got to do 61 additional transactions. So TIPS are a terrible instrument, and this is what Treasury asked me, is why are TIPS not selling? Because I said it doesn't match the goal of anything I want. But the whole problem is finance theory is entirely about principal preservation. Whereas reality is, I need cash flows. I don't care about the principal. I just want a steady stream, give or take. I don't need one big balloon amount at the end of 10 years, 15 years, 20 years, right? So you have this massive mismatch in cash flows. That's why TIPS have failed in this country. Right? They really struggle with TIPS.
Yeah. That's true. Well, I mean, let's suppose one could come up with the right instrument, and clearly your answer's a good one for, I mean, it seems to serve the purpose, right? And I was just thinking if you had sort of a ladder of zero coupon inflation protected securities, that would be
same
ideal.
thing, exactly, yeah.
But I guess I'm just trying to ask the meta sort of philosophical question, is all of retirement investing very misguided because people are trying to get greedy? All the 60, 40, 70, 30 stuff is just about being greedy. They're not trying to match their cash flows. They're just saying, oh, I want to get lucky in the market, right? That, I want to multiply my wealth by so much because, well, it's always, market goes up, and that's true in the US, but in Turkey, it probably doesn't go up.
So,
I definitely know a lot of countries where it doesn't.
So that's the thing, is we've been trained, but look at what the Fed did, right? The Fed did something crazy, which is they dropped interest rates to ostensibly create the wealth effect. Does everyone know what the wealth effect is? That is, if you have lower interest rates, wealth goes up, and then consumption should go up, right? So they were trying to stimulate the market. So guess what? They goosed the stock market, so they dropped interest rates, and your wealth went up because the stock market went up. But if you've got a bond duration of 35 to 40 years, which is what your retirement duration is, and you dropped interest rates as well, this went up by double. So every pension fund that I knew, when the Fed was lowering interest rates, was now more underfunded. What's the thing they do? They go and punt even more, right? There's two ways to fund your retirement. One is you save more, which nobody wants to do in this country. So then guess what? Then you got to punt like hell. That's when you start to go into illiquid assets. You start to hide your bets because they're not mark to market, right? So the Fed, by lowering interest rates, increased the wealth effect, but they lowered the relative wealth. And so Bob Merton and I wrote a piece in 2015 saying, hey, you guys have the equation completely wrong because you're messing around with a really long duration asset, right, in the denominator. Right? And this is all of insurance, right? Insurance is all about basically liabilities, which are typically long duration. Low interest rates are terrible, right? So this is the problem is, Powell and all his buddies are focusing on the stock market and the wealth, and they're not looking at the fact that if I'm trying to hedge myself out, I've got a problem.
Well, Bill Gross talked about it as a big transfer of wealth, right,
from the young to us. That's why I teach. I tell my students, I said, you guys have to be revolutionaries because otherwise we're going to steal from you.
Or from the savers to the speculators.
Yeah, basically. That's all it is. But basically the young are screwed because they're going to have to pay for our Social Security. They're going to have to pay $37 trillion of our debt. And they're going to have to save for themselves because they've got no safety net at all, right? Okay, so this is the model I built because I want to be quasi-academic, because then people were giving me hell saying you don't have an academic model for this. So this is the world I imagine, right? We have entities, whether it's a company or a government, that produce the cash flows, and they hire individuals, and then they sell financial instruments, which is a claim against the cash flow. Okay, so the instrument could be the bond, or it could be stocks, or it could be whatever you want, okay? And then I've got individuals who want to consume these cash flows, right? So I just took as much of reality as I could to build this very simple structure. Now what's interesting is, so we'll skip this. Okay, so this is now where finance theory goes completely wrong, right? Finance theory talks about the absolute risk-free asset, a zero volatility, zero correlation asset to everything, typically represented by the T-bill. And then they talk about risky assets, and then you combine all the risky assets and you get the market portfolio. Once you're in my relative world, I've started to create these relative risk-free assets. So by ignoring this, the whole model is wrong. And in a way, what factor investing is capturing is this missing variable. And that was my GRAPM. Right? All that you're finding in factor investing is how the liabilities were being proxied by the pension funds and the endowments. That's all it is. And that's why factors go in and out of style. Because when I started with the World Bank's pension fund in '95, everybody was in large cap. Okay, so that's why you had a small cap premium. You had the value tilt because all of us were in growth, right? And so on and so forth. So all these premia that they start to find was because the way I was proxying it was the assets that were on the short side of that equation. Okay, so I've done some tests which show that this is what it is, that the whole factor investing business was trying to capture this relative asset that we were proxying in different ways. Okay? Does that make sense so far? Okay? So that's why I'm not against factor investing in the sense that, hey, listen, if you can find a stream of returns that makes money, I really don't care whether there's an academic basis to it or not. But too many people try to write academic papers like Pharma French, right? I've had a huge argument with Pharma and French, saying you guys are just data mining what you missed in the CAPM model. So don't pretend like it's something more than it is. And that's why you find 100 factors. Because today, portfolios are so much more complex than they were when I started investing in '95. Right? So every time I pick an asset class to invest in, private assets, there's going to be some negative side to that trade which will give up a factor. And that's how you're going to be successful in factor investing, is kind of being dynamic in its rotation, not static in its allocation. Right? Because the industry is so dynamic. Right? Okay? Okay, so now let's go to reality, right? So some of my clients, Los Angeles County Employee Retirement Systems, $100 billion pension fund, when you open up their investment statement and you read, hey, what is the objective of managing this pension fund or this endowment? They typically say the fund's long-term performance is to generate risk-adjusted returns that meet or exceed its defined actuarial target, as well as its policy benchmark. So basically they're saying, I want to maximize net relative risk-adjusted returns, right? New Mexico public employees, the relative risk that I give to my agents is 150 basis points. My target volatility is 10.5%. So they're telling me very clearly how much relative risk are they willing to tolerate, how much absolute volatility they're willing to tolerate. And then what does academia do? Has no reference to these formulae at all. Okay? So actually, if you look at this beautiful paper, Sharp Tint 1990, if you haven't read it in your academic program, definitely read it. It's a really well-written paper. Sharp says, what's the optimal asset allocation when I'm trying to maximize funded status? And guess what? There's a lot of correlation to what your liability looks like. Right? So I just basically restated Sharp's problem to say, I want to maximize funded status subject to the volatility of my portfolio being 10.5% and target tracking error being 1.5%. Okay, so now here's a quiz, okay? Everybody knows the Sharpe ratio, right? Okay. Everybody knows the M-squared performance measure of Modigliani? Okay, so I'll teach you something new, okay? So Franco Modigliani writes a paper saying the Sharpe ratio is nonsense, right? Because it's not a performance measure, right? What does a Sharpe ratio of 0.5 tell me versus a 0.7? It tells me nothing, right? He says, why don't you report to me risk-adjusted performance in performance terms, okay? So this is a variation of the Sharpe. Okay, so show of hands. Here's your benchmark, right? We'll call it the S&P 500. Has a return of Rm and a volatility of sigma m. And you have two managers you can choose, okay? So you can choose either Milland. Milland has got performance R little a. So he's under the benchmark. And I've got performance RB, which is above the benchmark. How many of you are going to hire Milland? Nobody, okay. So you're all going to hire me? Yeah, everyone has to put show of hands, okay? You can't opt out. There's only two choices, okay? You have to either hire me, okay? How many of you are going to hire me? I beat the benchmark. Okay. Okay, so that's the classic answer, right? Why? Because it's a positive information ratio, right? You've learned information ratio, right? It's greater than 0. Modigliani comes up with this brilliant idea saying, no. These folks have got very different volatility, so you cannot compare them without adjusting, and the Sharpe ratio just naively adjusts volatility. What you should do is you should borrow as much money as you can and lever this up to have the same volatility as the benchmark. And I was terrible at art, so just assume that this is a straight line. Okay? I'm actually the terrible manager. So a smart investor should find the millions of the world who took a really good trade-off for the risk that they took, lever them up to the target risk that you want. I've taken a whole bunch of beta risk typically, right? Uncompensated beta risk for which you should not be paying me any fees. And because people didn't risk adjust me properly, I get hired by stupid Morningstar and all these people, right? I get a 5-star Morningstar rating. So Modigliani calls this measure the M-squared measure. It's a really nice paper, actually. It's worth reading as well. Okay? And so that's what I started with. But the argument I had with Modigliani is you still can't compare these two. Does everyone know what tracking error is? Right? So tracking error is relative risk, right? My argument with Modigliani is you can't compare these two still because the tracking errors relative to the benchmark are not the same. You only normalize the volatility. You didn't normalize the correlation. Okay? So the ranking, again, doesn't meet a ranking based on skill. Okay? So I was able to prove in 2000 that these are not good measures of performance. Because what happens is, now you better be careful because my math is terrible. Okay? Let's take time. This is a stochastic process. So this is your benchmark. This is your S&P. Right? It's a stochastic process. Right? It's got sigma b. It's got mu b. Right? This is your manager. Right? This is A, and then this is B. Right? The ratio of these stochastic processes actually tell you who's skillful and who's lucky for the number of observations you have. Sharpe doesn't find this out. Modigliani doesn't. And so I developed a new performance measure called the M-cube. Okay? And so the way M-cube works is you have to create a new portfolio which is a combination of the risky asset, the combination of the benchmark, and then the balance is either leverage or deleverage. Subject to the portfolio volatility should be identical to the benchmark, so that's the straight line, but also the two must have the same tracking error. So you're not only normalizing the volatility, but you're normalizing the correlation. This is the only measure that actually ranks mutual fund managers on a similar basis to the skill measure of this one. Okay? So basically what you do with this is you've got, you assume A is a stochastic process with mu A, sigma A. Then you've got B, which is the benchmark, which is mu B, sigma B. You look at the ratio of R sub t, which is nothing more than A of t divided by B of t. And from this, you can split skill from noise. Okay? It's nothing more than a stochastic process which has noise to it. And so you can show that as well. Okay? So this is the first paper I write in 2000 saying, hey, these guys missed the skill element and they're ranking people incorrectly. So you could end up hiring somebody who just took a lot of beta risk, which has been a huge trade in our industry, because I'm not normalizing for the fact that they took beta in it. Now, what's nice about this simple equation is I can solve for the asset allocation. And what was a big surprise to me is, unlike Markowitz, the asset allocation is independent of any expected return terms. So let me tell you a story, right? In 1998, I was at the World Bank in charge of 10 billion in assets for the pension fund. And so this is 1998. And I'd been trained in Markowitz and stochastic optimization. And I called up all my banks because I had to put in the expected return assumption into the model, right? And I said, what is your expected return on equities 10 years out? Classic. What do you think the average answer was? Annualized return on equities for 10 years. 10%. Yeah? Let's round it up, right? Okay, so what do you think the actual return on equities was in 2000 and by the time I get to 10 years out? After the crash? Annualized return, less than 0. I gambled $10 billion on the stupid assumption that I thought that I could forecast the expected returns even a year out. Okay? And Markowitz says this in his 1952 paper, which nobody reads, right? At the end, he says, this is a great model if you know what the forecasts are. But you've got to make forecasts of expected returns. You've got to make forecasts of all the volatilities and of all the correlations. By the time you make these forecasts, with even 5 assets, you're already talking about 25 assumptions. You screw even one of those up, your whole portfolio blows up, right? This is why all these endowments and pension funds are going to keep blowing up, is they're using these stupid techniques because these consultants have no clue at all about finance, right? They just tell, oh, we ran a Markowitz optimization, here's a pie chart, we picked the portfolio on the efficient frontier. There is no efficient frontier. We have no ability to forecast this stuff. So to me, what was a surprise when I come up with this is my asset allocation is completely independent of any expected return terms. Now, the problem is it's a function of volatilities, which are more stable than expected returns, and correlations, which is also relatively unstable, but fewer parameters to forecast. Okay? Does everyone get that? Now look at this, right? It's interesting because the allocation to the risky asset, let's call it equities, is a function of volatilities and correlations. The allocation to my beta is only a function of correlations. Okay, so there's no volatility component, which means that if you're underfunded and you don't have a high tolerance for risk, try to immunize as much as you can. If you have a high tolerance for risk, then you have a low allocation, and I'll show you this chart in a second. Basically, here's the tracking error, and then this is the correlation. And you can see that the demand for different assets changes based on your risk tolerance, right? So if your risk tolerance is high, you'll have a lot of equities. If your risk tolerance is low, you'll have a lot of the liability hedging asset, okay? So this is kind of a new paradigm for asset allocation, which has nothing to do with Markowitz optimization. Right? And even Tobin's thing about two-fund separation, never seen it in my 30 years of practice, right? So this is kind of where we now start and show, hey, we've got risk-adjusted performance and we've got asset allocation. The last question is, what is the asset pricing? Does this make sense so far?
But don't you get to the similar result, like, directionally? I mean, you're trying to allocate more to the risky assets,
so
have more tolerance.
So the part that the traditional method misses is this one, is the relative risk. Everybody focuses on finding the efficient frontier and then saying, what's my volatility target? And then they pick a portfolio. This little rho, tau, comes into a lot of the equation because I'm delegating the decision to somebody else. So because of that, it changes it a little bit away from the traditional Markowitz. Right? If I'd stopped here, then this is pretty much Sharpe, Modigliani, Markowitz. This one changes the paradigm. We're now in a 3-dimensional space, not a 2-dimensional space. Okay?
It makes a lot of sense, although you could argue now you should also adjust for higher moments and whatnot.
Ideally, yes. Yeah, I was just being, this is the level of my math, okay? So that's why I want these students to do that. You're absolutely correct. Because if you care about skew and you care about all of these things.
So if we talk about this, like your measure of risk is vol, and if you want to distinguish skills from luck, it's also a skill to get lucky when everything is going up.
Yeah.
So you should, skill is when the markets are going down and you are going up, during the drawdown.
So the way I designed the programs that I used to run was I want to make money when the client's portfolio is blowing up. So I want a dynamic negative correlation to the client's 60-40.
Yeah.
It's very hard to do, but that's how we stayed in business for 25 years.
My colleague from the department, Stan Jurasev,
Okay.
yeah, Rockefeller Jurasev, he does expected shortfall portfolio optimization for a living. And recently has a paper, Drawdown Betas, when he's challenging the GRAPM model by looking at drawdown betas, so betas computed during the drawdowns in some.
So that's what we do. So what we do is when we try to build our portfolio, we want to be negatively correlated when beta is going down, and we want to be positively correlated when beta is going up. It's not easy. So that's how we made a lot of money in 2008, was we had that profile. We had it multiple times. But it's very hard because sometimes these correlations flip very fast, right? So it's not an easy strategy to build, but that was our design. Our design was I don't want to always be negatively correlated to beta. I don't want to be always positively correlated because then why is the guy paying me? So why don't we create a dynamic profile of beta?
Well, or you
And
could
that's
just be
getting
zero beta
interesting
all the
because
time.
this is this setup is more like in your pension fund investing, right?
Yeah,
That
hedge
in
fund.
this
Yeah, if you're a manager,
cluster,
yeah.
Then you,
So you know what I call drawdown, right? I call it yield to fire,
yeah.
right? Which is how long and how much can you lose before your client fires you,
Well, we call it margin call.
right? Basically, if you have a terrific recovery, but your client fires you and you never get to that, your strategy makes no sense, right? So in an ideal world, and this is the challenge for all these smart young people, is actually you should build this more on a drawdown profile because capital preservation is more important as a risk measure than volatility.
Yes.
Academically, volatility is easier to solve for. There isn't a closed form solution for drawdown, and that makes it harder to solve. So then you have to do it through simulations or some variation.
There are close.
Of drawdown?
Yeah.
Oh, I'd love to see that. Okay, good. Thank you. Yeah, but this is my level of math, okay? I operate in basic algebra. So,
Close one, LP in your program.
okay, yeah, that's what you have to do probably. So yeah, you're right. The correct measure of risk is actually drawdown, right? Is how do I preserve relative wealth, not volatility. Volatility is kind of a bad measure, but it was the simple one that Markowitz starts with, and therefore all of us use it.
Some average drawdown.
Pavel, I'm sure you've seen some of the papers, and I'm sure since you've published in the space, like maybe around 15, 20 years ago, there was a lot of papers trying to fix the Sharpe ratio. It was very trendy to fix the Sharpe ratio along different. But my way of doing that, by the way,
because that's when we first met.
That's right, and in that context, I mean, but actually, I think your critique here is much more important. That the industry is based on so many flawed assumptions, like the fact that we can predict expected returns, which is, of course, kind of quite silly if anyone coming in from the outside who looks at that and says, "Oh, really? You can predict returns?"
And the amazing thing is the confidence with which they state that, right? So all of you are New York City residents, right? So New York City's pension has 5 different pension funds under the umbrella of the New York Bureau of Investing. Okay, each one has its own consultant. Each consultant has its own different expected return assumptions. So literally under the same office, there are 5 portfolios being run with completely arbitrary expectations because each one wants a certain portfolio. That immediately tells you what's wrong with the industry, right?
Well, that's why I live in the market neutral world. You don't have to predict
And that's what we're trying to do. Is we're trying to be market neutral over the long cycle, but negatively correlated when beta is going down, positively correlated when it's going up. It's very hard, but that's kind of the ideal thing that we're still striving for. Right? We haven't solved it. Okay.
Well, but it's the same problem whether
That's
you
why
do
it's very hard,
black limb
because,
or-
it would be easy, it would be mainstream finance.
Well, the problem for us has been that because the central banks bailed out every market decline, right?
Yeah.
You can't build an entirely systematic strategy. In the old days, you could actually have a systematic strategy which was very simple that would capture a lot of this. Now, because the interventions come so fast that when you're trying to capture the alpha when the market is in a drawdown, you don't get enough time to capture enough alpha because they bail you out. Right? This is your problem, is you ruin market discipline. Data doesn't mean anything because now when you get bad economic data, the market rallies because the Fed's going to cut rates. We were always taught bad economic data is bad for stocks, right? Ostensibly, right? Not anymore. Now bad data is good data, so you have to flip the model on its head. So they've really wrecked the whole.
Now it's tweets.
Yeah. In fact, that's what I told my students, right? At the start of this year, I said, that's it. Throw out everything I'm going to teach you. Just get a social, Truth Social account. And literally, he moves markets. He knows that, right? Yeah. He knows he can move every market, whether it's oil, gold, crypto, stocks. He knows he can move markets, right? So yeah, forget all my models, right? It has no meaning.
A couple of them, they know. More than one.
Few of them survive. Okay, so now this is a little bit boring. Yeah, sorry.
Do you have any empirical data as to how many fund consultants actually use the Markowitz efficient?
All of them, pretty much. Because
I have one data point. We don't.
I have all of them. Well, do you have a consultant?
That you have to ask our CIO.
Do you have a consultant?
We have a consultant.
Who is it, if I may ask? Cambridge?
Yeah.
Same. Yeah,
But we separated out the two decisions.
Okay, yeah. So I would say the asset allocation decision ideally should be made independent of the CIO as well, because he or she is setting their own benchmark. So that's bad governance, right?
It is.
Because we should,
Independent of it.
yeah. So it should be somebody separate who says, given the cash flow needs of the university, this is the optimal allocation. You now manage it, and we're going to give you a certain amount of relative risk to prove that you're skillful, right? I would say fire the consultants, okay? No consultant that I've met in 30 years is worth any value because they've never managed money before. They're basically CYA, right? What we call CYA, right? It's an excuse for the board to not take responsibility. Not one of the I know every one of them, right? I've been doing this for 30 years. To this day, I would not recommend a single consultant to anybody that I like, right? So they're using all these stupid methods, right? I know Cambridge extremely well. It's the same thing that they take to every endowment. There's no customization. So I would say get somebody really good to support the CIO. They set the benchmark. The CIO is the agent, right? Have a risk budget and keep them within that risk budget, and then let them do whatever they want within that budget. You can build a really good governance structure, eliminate all these costs of people who've never done it themselves, right? And they do all the manager selection. Manager selection accounts for 10% of the risk. 90% of the risk is asset allocation. And Rahul used to do this for Dow, the pension fund. 90% of the risk is asset allocation.
Sure.
But we spend less than 10% of our time on asset allocation. Because it's sexy to hire managers, because then you get invited to nice conferences. If you do asset allocation, you're going to be vacationing, in sort of Weehawken or whatever, right? That's true, really. It's all about how do you get the awards. You get the awards by hiring these managers, right? So the whole system is rigged to not do the right thing by the client. And so the client has to be really strong, whether it's the university or the pension fund, to say, this is what I want you to get me to. Oh my God, I'm running too long. Okay, very quickly, I'll set up the problem, how I solve the asset pricing model. Is I said, okay, let's assume you have a retirement investor. So there's two ways they can create a portfolio. One is they can hold the retirement bond. They can hold T-bills and stocks. Okay, so that's one portfolio of risky assets, liability replicating asset, and T-bill. Now, for the retirement investor, the education bond is risky, right? Because the cash flows are different, and vice versa. The second portfolio they can hold is hold the retirement bond, hold the T-bill, and hold the education bond. So now you have two portfolios which have a different mix of risky assets, but on a risk-adjusted basis, they should have the same return. And you do the same thing here, and now you solve it out, and you get a simple equilibrium equation, right? So one of the complaints that John Cochrane had about CAPM is a model which has too many free parameters, right? Everybody knows the CAPM formula, right? So expected return of RI minus RF is equal to beta times RM minus RF, right? And the problem is this can be anything, right? Because this is rho, sigma, the covariance, right? Sigma I, sigma m over sigma m squared. There's no limits on any of these parameters. So the expected return of an asset is whatever you want to make it out to be, because there's no restraint on any parameter. What's nice about this model that I solved out is everything actually is completely connected. There's no free parameter at all. So one, I have a formula for the risk-free asset, which you don't get out of CAPM. In CAPM, it's a plug value, right? Two is there's a very tight connection between all the relative risk-free assets. So they can't be sort of floating around on their own. They're tied in because of the portfolio construction. And then you get multiple equations for the risky asset based on whichever one you're basing it on. And all have to be the same, okay? Okay, so I've given you a lot of equations. Let's show you some real numbers, right? So I tried to do this with the Brazilian data because Brazil has an education bond for a child starting in 2030, an education bond for a child starting in 2040, retirement bond for somebody retiring in 2035, et cetera, right? So I have the volatilities, I have the correlations. And interestingly enough, then you can derive expected returns for all those assets with all these conditions being met, that there's no free parameters, and you get asset allocation recommendations as well. Okay, so essentially what I was trying to do is to say, give me all three recommendations: risk-adjusted performance, give me asset allocation, and give me asset pricing. So here's the homework assignment for anybody who wants to do this, right? Once I have 2 or 3 of these bonds, it gets very hard to get an individual solution. So I call it the multiverse problem, right? It doesn't converge very easily to one outcome. I can get multiple variations that meet this criteria. So the challenge for you, if you're interested, is can I just independently pick this variable, or is there a unique solution that actually has to be picked once you set up the problem? Okay? So I cannot have independent choice of the assets that I'm trading with. Okay? I haven't yet solved that problem. 2 is I just assume these correlations are whatever they are. But what I've now found out is those correlations are not sort of arbitrary as well. They have to have very specific properties. Okay? And there's the formulas. I'll send you the paper if you want. But because they're all interconnected with this variable called x, where there's a lot of correlations, all these correlations cannot take on any value either. Okay? So it's a really fun set of ideas that come out of this, which is, yeah, they all tie up, but I haven't got a single solution. Depending on how the optimizer works in Excel, I get whatever solution I want, right? So it's still a dangerous model in that sense, yeah.
So where did you get the expected return from?
So the expected return is solving for these equations, right? So I have these equations, which is I want to solve for RF, which is the T-bill, the retirement bond, the education bond, expected return, and I, which is, let's say, stocks, right? It could be the Bovespa index, it could be the S&P, it could be currency, whatever you want to call the risky asset. Subject to all these sort of conditions being met, that these correlations have to be so tight, but also the expected returns have to be so tight. The problem you have in CAPM is if I bump up the allocation to NVIDIA, CAPM really doesn't care about it because there's nothing about NVIDIA. It's kind of like folded into the market portfolio. Here, if I bump up the allocation to NVIDIA, then it'll show up that IBM gets impacted immediately because of the correlation. So I called it the entangled markets hypothesis because I don't think pharma has tested this idea of if there's news about NVIDIA, they only check what happened to NVIDIA stock. But I know that all the other stocks that are in that GIC category should all be moving because I see that in the market every day, right? If NVIDIA has an announcement, Intel gets affected. CAPM doesn't allow you to do that. So that's why I think pharma's efficient markets hypothesis is very limited because he's not capturing the spread of news into the market. Ostensibly in this model, I can't but have that. If I bump up NVIDIA's allocation, it'll have to affect any asset that's highly correlated with it.
So these expected returns are the ones you need for
to solve. Yeah.
To match the assets to the liability.
Exactly. And it has to meet all these criteria that I should be able to get the T-bill return using either the retirement bond as the primary asset or the education bond. So there's a lot of conditions that don't allow me to get sort of completely random outcomes like I can get from Cambridge Associates or Watson Wyatt or whatever, right?
But then the bonds you can design to have whatever return you want. S&P 500.
So these are expected returns, right? So this is, given all of these correlations, these are my expected returns assuming this equilibrium. But to be quite honest, this model doesn't make sense because it only makes sense if everyone is behaving the way I've modeled it in how they're setting up their portfolio. So it's a normative model, it's not a positive model, right? If these bonds become more popular and everyone's doing it, then you can start to use it. Right now, it's just, I was trying to show you can get results that are internally consistent, but this is not reality yet. Okay? We're getting well past into drinking time, so so here's a couple of problems for you, right? If you guys I tried to do this in Mathematica, I couldn't quite solve it out. Should we be solving the problem in reverse, kind of like a Black-Litterman variation, right? Am I solving the wrong variable? Should I be solving for something else, right? So there's a nice problem to be done. And I think there's probably an analytical solution. Then ideally do a continuous time version, right? This is only a one-period model, very simple. I think you have to do this in continuous time. What happens if you have multiple agents, right? So there's a really good paper by, does everyone know Doyne Pharma? Doyen Farmer was a Los Alamos physicist, set up a hedge fund, absolutely brilliant. There's a very good paper he's written with a guy called Robert Axtell. It's a 2025 paper, and again, I'm happy to send it to you. But they talk about modeling agents in the economy, unlike how we assume in finance theory, which is a single representative agent. It's a very nicely written paper on how you should model multiple agents, because that's what markets are all about, okay? So yeah, so if anybody's got free time and wants to look at a problem and write a paper, I'm happy to help you do this. Then I was able to show that you can get a general equilibrium model. So last slide, which is, CAPM has only one equation for beta. In the 2-asset case where I had retirement and education, then I have a few. You can do an n-asset case, and what happens is you just have a lot more equations tightening up the solution, right? So, but I think once you start to get into like 3 or 4 of these gold replicating assets, the solution becomes more complex, right? It's not easy to solve. Okay? And that's pretty much it. Right? I'll stop there, I think, yeah. Any questions? Yeah, go ahead.
Yeah, thanks for joining us today and sharing your research results. My question is more on your experience in the World Bank. Was the pension fund within the asset management arm of World Bank, or is it more the banking that does credit, mortgage lending? So I was in Treasury. So when I left MIT, I joined the Treasury. So does everyone know how the World Bank works? Okay, so what the World Bank is it's basically, it's a United Nations organization, right? It came out of the UN. And the idea was, how do we lend to poor countries who don't have access to capital markets, right? So all the countries in the world have capital, but it's mostly callable capital, very little paid-in capital. And because of that, the World Bank has a AAA status. Okay, so I was issuing bonds even cheaper than US Treasuries, right? We then take that funding and then we lend it out to the countries with a small premium so that it covers our costs. So now Rwanda can borrow close to treasuries, right, US Treasuries, and that's the function that the World Bank did, with the idea that if I give them cheap financing, then we can help, build bridges and infrastructure, et cetera, right? Poverty reduction, education. But because they've had so many staff, there's 2 functions. One is, when we borrow, until we lend it out, we have to manage the liquidity. So there was an investments group. When I was there, we managed about 20 billion. Now it's like 50 billion. And then next to that was the pension fund, which is typically meant to be independent of any internal thing. So when you run a pension fund, fiduciarily you're required to only make decisions in the best interests of the pension fund, not of the World Bank. Okay? So that's a separate unit, but it's under the investment umbrella of the World Bank. Got it.
Okay? And again, it's one of the interesting problems. Again, talk about just being lucky to get the best job in the world, right, coming out of school. You were borrowing in all the markets, right? So you got experience investing, issuing bonds in global markets. You got to go and train central bank governors and their teams and ministries of finance. So you had like a half education hat on. And then because you were the World Bank Pension Fund, our liabilities were not just in dollars, but it was in every currency in which anybody had worked in. So we had some people getting Indian rupee pensions. We had some people getting euro pensions. So you had to manage a really complex liability. So then the asset allocation challenge becomes even more interesting, because it's not just, do I match the cash flows, but I match the cash flows in the currency in which I'm going to be paying it out. That's like a next level problem. So it was a terrific job, probably one of the best jobs I've ever had in my life. Yeah.
How much was it externally managed?
All. That was the reason I left, right? The reason I left was I had all these managers, and I go and join JP Morgan, who's a manager I hired, which was very mediocre, right? And we had more talented staff at the World Bank, but for reasons pertaining to the board members not wanting to take political risk, we farmed it out to asset managers. But literally, we were managing 20 billion, 2 desks down, internally. We could not manage the $10 billion pension fund internally. So that's when I left. Right? So that's the problem, is there's too much politics that goes into managing the pension fund, which isn't done in the best interest of the pension fund people. Right? Sorry, yeah?
I'm not quite sure how retirement funds work actually, but do they not do any marking to the cash flows that they need to do?
So actually, the typical pension fund, if you read this, because I teach at Georgetown, my students have to do their final paper on evaluating some public pension plan, right? So typically, if you're a pension plan, what will happen is they'll do, let's say dollar cash flows, right? And this is time. And most pension funds will have a profile that will look a little bit like this, which is hump-shaped. Okay? And this is called the defined benefit pension plan, where if you work for that entity, then they guarantee your pension. What happened is, because a lot of these pensions did not do this matching, first when the tech bubble blew up, and then after 2008, their funded, in the 1990s, all of them had funded status greater than 100%. But all of them had 60-40 portfolios. Okay? To Milan's point, it was doing great, right? In 2000, when they blew up, this happened, right? So you go funded status less than 100%. At which point, every employer pretty much around the world slowly said, we need to get out of this business, because what do I know? I'm a car manufacturer. Managing this is really like managing an insurance business, right? Looking at the liabilities, looking at assets. So all of the companies stopped giving you a pension. So we've gone from defined benefit to what's called defined contribution, where you're now bearing the risk. So the benefit of a defined benefit pension plan is they were pooling all the staff across multiple generations. So you really could have like a 50-year horizon in making investment decisions, technically. The moment it goes to defined contributions, you have one lifetime to get it correct, and otherwise you're screwed. So the whole system is now rigged against young people like you. I still get a defined benefit. Do you get a defined benefit? This is the problem. So the sad part is, because of bad asset management, we killed a really good system of pensions. That's my sort of frustration, is by using all these bad finance theory models, we destroyed defined benefit, which is really what it should be. Now, I'm supposedly, I've been investing for 30 years. If you look at my DC plan, it's a disaster. So I literally designed that SELFIES bond so that I never had to make another decision again. Because it's so complicated. To Milan's comment, when do I switch between stocks and bonds, right? You got to have a market view. Do I trade? This is not easy stuff for the average person to do, including financial professionals. Right? So now the problem is the whole world has gone to DC. And in DC, when people retire poor, governments bail them out. Because even Putin got scared when the retirees protested, because you never want to upset retirees. So governments are going to keep bailing out people, and that's kind of a problem for you, because it's going to come out of your taxes. Right? Social Security, classic example. Social Security, Franco and I wrote a book in 2004 predicting that trouble would happen. I think by 2033, Social Security runs out of extra cash, which means either they have to cut benefits by 30% or your taxes go up by 25%. So that's why I teach, so that I'm trying to get you young people to start fighting, saying, our generation screwed all of you over. Come on, give something back. It's really bad. So the sad part is, this was a brilliant system, because the contract was, you work with me for X number of years, and I pay you something similar to the paycheck you got when you worked for me. Today here, this is completely random. You have no idea what you're going to get. And definitely, if you put it in those target date funds, you're in even worse shape.
You can log in and see it.
You can check. Yeah. So in fact, this is exactly. So the statement comes. So that's the problem, right? Is the statement comes and it says you have $100,000, right, or $200,000. It doesn't tell you what lifestyle can you finance, right? So the statement gives you completely useless information. It'll give you every asset and what return it had over the last year or 5 years or whatever. What the hell do I do with that data? It's completely useless information. So the idea behind SELFIES was, if I can get people to say, my goal is 5,000 of these bonds, at least I've set them a goal that they can track. And then as they're getting close to their point of retirement, they can say, oh, I know I've locked in 30,000. To get to 50,000, I better save more, take equity risk or some other risk, or postpone retirement. Right? That's an equally valid choice. So what we're trying to do is tell people, you set your goal as 10,000 of these bonds, you've only got 8,000, you better do one of these three things. Right? So that's what we're trying to do, simplify it to give people information, even if you're a finance professional, that you can understand and hopefully make something intelligent out of it. Does that make sense?
Yes.
Yeah, so the sad part is the decline of the defined benefit is probably one of the biggest tragedies in the finance space. So.
But by the way, when they talk about the mounting debt and the 30 trillion or whatever,